Right now, at this very second, Exact Sciences Corp, ticker symbol EXAS, is trading at exactly $101.00, up 33 cents or 0.32% on the intraday chart. If you are looking at your screen wondering why the stock isn't moving like a volatile tech name such as Tesla stock or Nvidia stock, it is because the game has completely changed overnight. The chart you are looking at is no longer a reflection of typical supply and demand technicals. It is now a reflection of a massive corporate acquisition. The expectation from the average retail investor might be that the stock should skyrocket indefinitely or fluctuate wildly, but the reality is far more calculated. We are seeing a classic merger-arbitrage scenario unfold in real time, and the gap between the current price and the buyout price tells a story that most casual observers on Robinhood or SoFi Invest completely miss. You might be expecting the stock to hit the buyout price of $105 immediately, but here's the twist. It's sitting at $101. That $4 gap is not an accident. It is the market pricing in risk, time, and the regulatory hurdles that stand between today and the deal's closing in 2026. While your friends might be chasing the next big pump on Robinhood crypto or trying to time Apple stock, the smart money is looking at this spread and asking a very different question. Is a guaranteed 4% return worth the risk of the Federal Trade Commission stepping in? This is where the tension lies. The expectation is a done deal. The reality is a long bureaucratic road ahead that keeps the price tethered just below the finish line. Let's look at what is actually happening on the trading floor today. The volume is absolutely massive, significantly higher than the 30-day average, which is typical after such a major announcement. Institutional giants and Fidelity wealth management funds are likely rebalancing their portfolios right now. Some are selling to lock in the massive gains from the sudden jump, while arbitrage funds are buying to capture that $4 spread. This creates a unique tug-of-war that effectively pins the stock price in a tight channel. Unlike the wild swings you might see in Robinhood stock trading forums discussing meme stocks, Exact Sciences is now trading with the precision of a bond. It is less about growth now and more about probability. The market is effectively saying there is a 95% chance this deal goes through, but that remaining 5% of doubt is what keeps the price at $101 instead of $105. To understand why this matters, we have to step back and look at the company itself. Exact Sciences has been a dominant player in the cancer diagnostic space, most famous for Cologuard, that non-invasive screening test for colorectal cancer that you have likely seen advertised everywhere. For years, individual brokerage accounts and aggressive growth funds held this stock because of its massive recurring revenue potential. They were betting on a future where cancer screening becomes as routine as a dental checkup. Abbott Laboratories, a titan in the healthcare sector, clearly sees that same future, which is why they put $21 billion on the table. This isn't just a small buyout, it is a massive consolidation of the diagnostic market. For a user on a Fidelity trading platform or someone using Schwab Intelligent Portfolios, this validates the long-term thesis that diagnostics are the next goldmine in healthcare, distinct from the roller coaster nature of pharmaceutical drug development. However, let's talk about the elephant in the room, the regulatory environment. In recent years, we have seen regulators take a very aggressive stance against large mergers, ostensibly to protect competition. If you are engaged in self-investing or managing your own intelligent portfolio, you need to be aware that the biggest risk to EXAS right now is not earnings, and it is not sales growth. It is the gavel of the FTC. If the government decides that Abbott owning Exact Sciences creates a monopoly in cancer screening, they could sue to block the deal. That is the nightmare scenario that keeps the stock at $101. If the deal falls through, the stock doesn't just stay at $101, it likely crashes back down to its pre-announcement levels, which were significantly lower. This is the binary event risk that differentiates this trade from buying a diversified ETF on SoFi Investing or Fidelity ETFs. You're essentially betting on the lawyers, not the doctors. Let's break down the price action we have seen over the last 24 hours. The jump was violent and immediate, a vertical line on the chart that cleared out every short seller instantly. If you were shorting this stock on Interactive Brokers, you likely faced a margin call that wiped out months of gains. This creates a vacuum effect where the stock finds a new floor. The current movement, that tiny plus 0.33 gain today, is just noise. It is the stock breathing after a sprint. We see this often in Fidelity mutual funds that track merger targets. Once the news is out, the volatility vanishes, replaced by a slow, grinding wait. It is boring, but in the world of investing, boring is often where the professionals make their money. They are not looking for excitement, they are looking for yield. Now consider the broader market context. We are in an environment where interest rates and inflation are still key topics of discussion. In a high-rate environment, cash deals like this are expensive for the acquirer. Abbott is paying cash, which means they are deploying capital that could have earned 5% in a risk-free treasury. This signals their immense confidence in Exact Sciences' cash flow. For you, the investor, this is a signal that real assets and real cash flow are becoming more valuable than speculative growth stories. While Tesla stock might move 5% a day based on a tweet or a battery rumor, Exact Sciences is moving based on audited financial value. This is a rotation from hope to certainty, a theme we are seeing across many investing sites and online investment communities. I want you to take a moment and think about your own portfolio. Comment below how many shares of Exact Sciences you currently hold, or if you are planning to sell now to lock in the profit. Are you going to wait for the extra $4 or take the money and run? Let's look deeper into the self-investing angle here. If you are using Robinhood Cash Management or a SoFi robo-advisor, you might wonder if you should buy EXAS now. The answer depends entirely on your patience. Buying at $101 to get $105 is a strategy called risk arbitrage. It's usually the playground of hedge funds, but with online investing platforms democratizing access, anyone can do it. However, you must understand the opportunity cost. Your money might be tied up for 12 to 18 months. In that time, Nvidia stock could double, or it could halve. Apple stock could pay out 4 dividends. By tying your capital to EXAS, you are effectively parking your cash in a high-yield savings account with a small risk of total collapse. It's not a strategy for the impatient, and it's certainly not what Robinhood fractional shares were really designed for, but it is a valid strategy for capital preservation. The business model of Exact Sciences is worth revisiting to understand why Abbott paid this premium. They didn't just buy a test kit, they bought a logistics network. Cologuard involves shipping a kit to a patient's home, having them use it, shipping it back to a lab, analyzing the DNA, and sending results to a doctor. It's a complex logistical dance that Exact Sciences has perfected. This last-mile connection to the patient is incredibly valuable. Most Fidelity brokerage analysts will tell you that healthcare is moving towards the home. We're seeing it with telemedicine, and we're seeing it with diagnostics. By acquiring EXAS, Abbott secures a pipeline into the consumer's bathroom, a place where traditional big pharma has almost no reach. This is the moat that justifies the price tag. Comparing this to other platforms, if you look at Interactive Brokers trading data, you will often see heavy options activity around these merger stocks. Traders will sell put options at the strike price of $100 or $95, betting that the deal will support the stock and prevent it from falling. This is an advanced strategy, but it highlights how Interactive Brokers stock trading tools allow for more nuanced plays than just buy and hold. Meanwhile, on the Robinhood app, you might see a surge in buying from retail investors who simply see the up 20% green arrow and jump in, not realizing the upside is now capped at $105. This disconnect between the sophisticated options plays on interactive brokers and the momentum chasing on Robinhood is a fascinating study in market psychology. We also need to talk about the alternatives. If you sell EXAS today, where do you put that money? The tech sector is crowded. SoFi stocks and fintechs are volatile. The Fidelity mobile app might be suggesting defensive sectors. But this merger signals that M&A, mergers and acquisitions, is back. We might see a wave of consolidation in the biotech space. Small companies that are burning cash but have great technology, similar to what EXAS used to be, might be the next targets.